People need an income that's guaranteed to them.
If you lose money to taxes, you're never getting that money back.
You need to get serious about adding some lower risk.
Greed. I don't like greed.
The thing to be afraid of, honestly, is the thing that we're not thinking of, the black swan event.
There's a tsunami coming. Bye.
Welcome to Retirement Coffee Talk with Charisse Rivers.
Just coffee talk.
There's a lot of noise, a lot of chatter. Who do you listen to? Who do you not listen to? You have to stay focused.
A fun and informative look at the issues of wealth, retirement, and protecting your life savings.
These advisors out there that were trained to sell, and have all these fees. They don't want to talk about this product, so they make less money.
And now, Retirement Coffee Talk with Charisse Rivers.
Hello again, and welcome to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. Online, you can find us, as always, at zinniawealth.com, ZINNIA wealth.com. What do we do here? Well, we talk about retirement. We talk about when you go away from the 9 to 5. You're gonna hang up your cleats, so to speak, and then one thing that stops is the paycheck, and that is where Charisse comes in, helping you build that paycheck for your retirement years. Charisse, how are you doing today?
Doing fantastic, getting plans ready for summer. We're about a month out and trying to figure out that plan. That's always fun, right? Planning never leaves us, you all, whether it's retirement or it's your trip while you're working. And when you have kids, what are we doing for the summer? Because I only have 2 more summers with Miss Ella, and then she gets to do what she wants. So if she doesn't want to hang out with me during the summers, I got to pack it all in now.
Mom, you're not cool anymore. I'm so sorry. Yeah. Well, you know, that's true when we talk about planning summer vacations, and that's one of those little metrics that we say a lot. People will spend more time planning their summer vacation than they will on their retirement, and it's kind of crazy. Your vacation lasts a week or two, and your retirement's going to last 20, 25 years, so it's worth a little time to sit down and talk about it, isn't it?
Definitely, and for years I've seen that, so that is a true statement.
All right, well, let's talk about it a little bit, because some of the things that you worry about when it comes to retirement is, of course, the stock market. You've been pounding money into that 401k or whatever it is, and then you watch that market bounce up and down, as it has been lately. And what some people will try to do is something called buy the dip. They'll have cash on the sidelines, market goes down, they push money in, hoping that it'll go back up again. This is Jack Huff, and he's talking on Sunday mornings on Barron's, and here's what he has to say about buying the dip.
Buy the dipitis. That's when investors who have, tripled their money in the stock market in a decade and who haven't really seen a bear market that lasted longer than a year since 2009, they use every 5% downturn as a reason to pile on risk. I don't think that investors should flee stocks right now, but I think they should be building some more resilience, because I think the stock market is more expensive than it looks.
Interesting. All right. So, Charisse, talk to me about buying the dip. I would depend on you, my financial advisor, to go in and do that. Is that a good thing to do in retirement?
No, I do like how he called it buying the dipitis.
Yeah.
I also like how he talked about building resilience. So there is a difference of buying the dip and depressed stocks. And when COVID happened, we're buying depressed stocks, right? And we were buying at the dip. So there was 2 opportunities you had to do that during that time period. So, you had the airlines, you had the cruises. So there was a dip there, and there was a big depression in all those stocks. But now you fast forward and markets are moving forward, but there's always an opportunity to buy depressed stocks, because not all stocks go all up at one time when the market is moving forward, right? So buying at the dip is a tricky strategy, right? And you need to be a professional and really know what you're doing to do it, because a lot of people will wait for the dip and have too much cash for too long, and then they miss the dip. Or they jump in halfway and they've already missed part of those returns. So I've just seen this happen over and over and over again. And I see that more with retirees, because they're nervous about it, right? And they want to give it a jab. They want to DIY this thing and figure it out on their own. And it's continued missed opportunity. And what if there isn't a dip? Let's say you're waiting for the dip and the next 6 months the stock market goes up 10%. You miss that 10% growth. But let's say it comes down 5% and you're Johnny on the spot and you're like, I'm going to buy it at that 5%. Well, you lost 5% by not buying it, right? Because you're waiting for the dip. So it's not usually wise unless you're a complete professional. So what we like to do is not try to time the dips, but I like looking at depressed stocks. And they're coming and going all the time. So I just think there needs to be another open conversation about how that truly works, because too many people out there are like, I'm waiting for the dip. No, don't wait for the dip. Let's look for the ones that have already dipped. And it might be 2 or 3, right? And sometimes there's none, but usually there's a couple.
Well, one of the things that you and I have talked about is that buying a depressed stock is very different, as you just said, that buying the dip. And there's bunches of money managers out there that are trying to do this very same thing, and they aren't very successful at it either if you look at their track records.
Yeah.
So and Sharice, you've also talked about this, is sometimes people have their money, they've got their retirement plan, they've got their safe money, they've got their investment money, they've got all of it all set up, and then they'll put a little on the side. Hey, Sharice, can I just play a little bit in the market? Can I take 3 or 5% of my money? And you go, yeah, go ahead and do that. But that's not the way to use that 5%, is it? Because that is just putting more risk on. It's piling on more risk.
Yeah, but people can't help what they can't help, Randy.
Yeah, I'm talking theoretical. You're talking real life, aren't you?
I sit down with people every day. Like, there's a human element that we just cannot resist. But I'll tell you, our dividend portfolio, it trades quarterly. And the rate of return we had on our dividend portfolio was outrageous. Plus, it paid an average of 4% dividends. But a dividend portfolio should not really produce this high level return. But it was because we weren't buying at the dip. We were buying some depressed stocks inside of it. So it was really clever. It was a great producing portfolio. And I can't talk about returns over radio, but it's not typical because a dividend portfolio has slower growth because you get paid that dividend. So it's nice when you can catch both ends.
Well, many of us just want to put money in the market and make sure we don't lose it and move it up a little bit at a time. There are some of you out there that like to play the game. This might not be the game that you want to play. Let's sit down and talk about your portfolio, your risk level, how you want to approach retirement. Give Sharice a call. Let's talk through it. We do a no-cost, no-obligation meeting. It's called a complimentary retirement consultation. You're going to see it on the website. If you go to zinniawealth.com, there's a gold box there, and you click on that. Put a little information in there, and the team will reach out to you, or you could just reach out to the team right now, 833-368-3680, 833-368-3680. Well, speaking of markets, when we talk about a depressed market, Moody Analytics, and we've talked about them before, they've been watching the economy for like 80 years, and they have this metric that probably some kind of a formula or something like that, and there's a sliding scale, and they said every time this goes above 50%, we're going into a recession, and it has been right 100% of the time for the last 80 years. You know where that index is right now? 49%. Okay, so they really think that this is in our future. So, Sharice, if somebody is retiring soon, that's uncomfortable to think that the market would go down significantly right when you start retirement. That brings in something called sequence of returns. Let's talk a little bit about entering retirement on a down market. That's probably one of the worst things that can happen to a retirement, isn't it?
So we need to talk about sequence of returns, because sequence of returns is equivalent to the fear of running out of money, because all it means, and most people don't understand it at first until we kind of show it on our diagram, is the dollars you are living on while the market's either going up or down. So if the sequence of returns are positive, we have no worries, right? The first 5 years of retirement, we really just don't have a whole lot of worries. But if your first 5 years of retirement, the sequence of returns, the stock market's going down, we do risk the fault of failing our portfolios and potentially running out of money if you are pulling money out of that. So I was just doing a workshop, and I was trying to explain to everyone how sequence of returns is a critical sense that we have to make sure we understand, because it's going to help you decide how to manage your portfolio. And I said, listen, how many of you in this workshop were retired in 2000 when the market went down 33 months? And they all said none of them were, which I knew. And then I said, how many of you were retired during 2007, 8, 9 when the stock market went down 50%? None. And so then I said, okay, now think about it. you are all living on your money. You're not growing your money, meaning putting money in anymore and contributing to it. You're in decumulation. They're living on it. So you're telling me none of you have lived on your money while it's in the stock market going down. And they all looked at me like, oh, she's pulling a point here.
Yeah.
And I said, now think about it. Let's go back to at least 2007. I said, 18-month decline. What would you do today if the stock market went down 18 months? And I said, you need 30 or 40 or 50,000 from your portfolio? And they all nodded yes. I'm like, so in my office, I would say mitts off. If the market goes down that far and we didn't catch you on the ride down, you can't touch your money, because if you touch your money, that's how you risk running out of money. The sequence of returns was negative, especially if that's when you first entered retirement. They all looked at me like, oh, reality check. You're right. We haven't done that. We actually don't know what that's like. So I said, think about the generation before you who retired in 1999 before the big crash, or who retired in 2006 and 2007. And they were doing this. Learn from their lesson, because it will come back. And things have been so good since 2010 moving forward that you forgot what could happen. But not only did you not forget it, it's not your fault. You've never experienced it. And it's been so long that it could crush your retirement. And they all looked at me and they went, oh. I'm like, so if you have Fisher Investments or a company that's just doing a 60-40 portfolio, you're screwed. And the reason why is because bonds went down 23 to 26%. You can't take money out of your bonds, but the stock market, S&P 500 went down 50.1%. So the point of bonds is to have less risk, but you can still risk money, and you couldn't touch those bonds for 2 years. So what are you living on so you don't have the sequence of returns risk, so you do not have to worry about running out of money? And that is why a written plan is the most important thing that you can do in retirement. If you're going to plan for your trips, you better be planning for retirement, because you don't want to be the sequence of returns candidate where you start losing and you're still forced to pull money out. And what if you have to take an RMD? You're forced, you're 73 years old, you're taking money out of your retirement accounts and you don't need the money, where you're selling the stock at a loss. Yeah, you got to pay the taxes on it, and maybe you can reinvest it into the same stock, but you're not going to do that. People don't do that. So think about how much money you need for the next 5 to 10 years. Button it up, make sure it's there so you don't ruin your income strategies. Because the last thing you want to do is, hey, honey, we can't book a cruise because the stock market's going down. And hey, history says it takes 4 or 5 years to get back to even. So for 5 to 7 years, you're going to tell your wife that we can't book a cruise because we can't touch our money because we didn't plan? Happy wife. Happy life.
Happy life. There it is. Well, there's got to be different places where you get your income from. It can't just be pulling money from a market, because a market can go down. And as Sharice says, you're pulling money out of a falling market. Now your 4% becomes 8% in a very short order. Let's talk about income planning. Let's talk about income sources and something outside that stock market. Give Sharice a call. Let's talk about your retirement plan, your paycheck, your income in retirement. Here's the number. Here's the website, 833-368-3680. 833-368-3680, or online at zinniawealth.com, ZINNIA wealth.com. There's a gold box there. Click on that. It says complimentary retirement consultation. It's a fancy word for let's get together and have a free meeting, okay? And let's get a date on a calendar. Again, zinniawealth.com or 833-368-3680. Okay, another season that's coming up here. We talk about summer. Wedding season is coming up. May and June weddings are all over the place. And this is Anissa Coleman. She's a wedding planner. This is Dad's biggest nightmare right here. And she's going to tell us what things are costing these days.
For a luxury wedding, I had to put a minimum in place. So a minimum wedding right now for me is between $95 to $150. That's like on the surface. Now, once we start putting in those bells and whistles, those numbers grow. That number sounds not realistic to a lot of people, but that's what it costs. You're seeing this. This is what people are spending. This is what they are doing. Your vision is your vision, so it's still going to cost
$90,000 to $150,000.
Wow.
That wedding, that marriage better last.
Where does she live? This is why when I got married years ago, I was like, let's do something simple.
Yeah, I did too. Let's spend the money later after we get married, you know?
Mm-hmm.
All right. So this is something that, I've talked to people I talked to an advisor just recently whose daughter got married. They spent $80,000 on flowers. And I was like,
what?
Are you kidding me, man?
Dang.
And there are some shocking costs when it comes to weddings. So let's bring this into the retirement world here, Charisse. What are the shocking, unexpected costs that people have in retirement? They may come in and they go, man, I didn't see this coming. Or what happened there? Why didn't somebody tell me about this? What are some of those instances?
Yeah. So, gosh, I can go down the line for sure. Let's say, when people do retire, Randy, I'll say they have this vision. They're going to retire. They're going to go in their golden years. They're not 100% sure what they're going to do. But when they sit down with us, they know what their expenses are. They know what their assets are. We figure out this plan. And then I coach them up about, hey, we got to be careful because there's some hazards along the way. And so here are those surprise hazards, but most people don't know about them unless you work with us. And one of them is Social Security taxes. And I just did a workshop and I made it very clear that there is a provisional income formula that dictates, and there's a math equation, how much of your Social Security is taxable. And it could be taxable up to 85%. It could be taxable up to 50%. And then I show them, hey, if you're married filing jointly and your income $66,000, you are hitting, depending where the income came from, you are hitting the 85% taxable threshold. And so what did that mean to them? It meant as if you're a snowbird, you're paying state taxes and federal taxes, your taxes were like $7,000. Okay. Now, I said, what if I could push you by teaching you a tax strategy to the 50% provisional income formula number? And what it did, it took up their taxes from $7,000 to $2,100. Nice. And I said, with proper tax planning, we can get you there. And so it's always a surprise for people who don't sit with us, because what happens as they have to pull money out of their IRAs, they're noticing they could be paying $2,000, $4,000, $6,000 more for doing so. So we want to try to avoid those extra tax costs. The second one people don't know about is a slam dunk. It slaps you right across the face. It's your Medicare penalty. It's called IRMA, ugly IRMA. It's ugly because if you sell a house, those dollars that you make on that house get applied to this math equation that now you're capitalizing and giving more money back to Uncle Sam and Medicare. Your Medicare Part B premium will likely not be $200 a month. It'll be likely $600 to $650 a month for you and your spouse. That's each of you, because it has a 2-year look back. And the same thing, you only have to do it for 1 year, but if you continue to have high income threshold or selling stuff every year, it could be a real problem. So that's definitely one hazard. The second thing we have to look out for is, what are those things that we forget about that we might do? Dentures, false teeth, all those things. I forgot years ago to tell people, hey, there could be a phase where dental pops in, and we want to make sure we have funds for that. People pay $20,000 to $50,000 to get this stuff done, Randy. And so what are those little hiccups? Those aren't penalties, but those are just costs I want to forewarn you about. And what about like healthcare? Long-term care. If the average stay is $7,000 to $8,000 a month, in 15 years, it's going to be $14,000 a month. Where are those dollars coming from? So it's not a penalty, but man, you're in a penalty box when you go into a facility like this, because if you got a forced hand, maybe you're forced to go in, and how do you pay for it? So thinking through the nuances of how do we protect your health care in the future so that the surviving spouse is not left destitute in the house because you had to spend all your money on care, because maybe you're one of those people that were in there for 3 to 5 years because we had dementia, because you can be super healthy and be there forever, right? So there's a lot of things you can look at when it comes to surprises in retirement. Those are just a few of them, but there's so much more.
There's something that I find really difficult, and that is as you sit down on a spreadsheet and say, okay, some financial advisor is going to look at you and say, you got to write down everything that you spend per month. And that's an eye-opening situation right there. I'm telling you.
Every time.
Because you got to think about, some of the stuff that you pay like once a year, like car insurance or life insurance or something like that. Then you kind of put that out per month, and what would that cost me per month and all that kind of thing. But, Charisse, just in the last couple of months. I mean, here's my little tale of woe. They're doing construction out in front of my house, and they're resurfacing the road, and they're doing a lot of stuff. Everybody in the neighborhood is getting nails in their tires. And we're all repairing tires, and it's been just nuts. And all of this cost that's going on there. And the other day, I hit a pothole, and I bent my rim, and I have to replace the rim. That was $800 for that. You know, I mean, that stuff is going to happen to you while you're working. And it's also going to happen to you while you're in retirement. That kind of stuff.
Yeah.
I mean, gifts and all the different things and stopping at Quick Trip and all that. It's hard to get a handle on those kind of expenses, but they're going to happen in retirement. I mean, do you literally have a line item for like slush fund accidents or something like that?
Yes, I call it the miscellaneous bucket.
Okay, all right.
And there's always, because if there's something they forgot to tell me or if we got it all dialed in, there's always a monthly miscellaneous bucket.
Yep.
We have to build that into the plan because sometimes those buckets can get a little big and hefty.
I heard somebody say one time, every year you should write in a $10,000 event. And I go, $10,000? And they go, now look, it could be something really cool. It could be a real positive thing. You're finally going to take that trip to Italy. You're finally going to take that cruise. You're finally going to do all that stuff. Or new grandchildren.
Finally going to break.
Yeah, exactly. Or it could be the other side, as you're saying. Oh, my gosh, the roof is leaking. Oh, my gosh, I need new gutters. Oh, my gosh, the wash machine and all these, the refrigerator went. There's going to be some kind of an event like that in your life. And that is stuff, if you're doing this yourself, do you write that in? Probably not, Charisse, but you've seen it so many times.
I have. And there's the trip bucket we work on. Some people are like, I want to spend 10 or 20,000 on trips a year. But then there's that other bucket. What if this happens, this happens? You know, what if I need a down payment on a car? There's always a what if. I see it every year in so many households. And that $10,000, if that what if doesn't happen, then you get to spend it on you.
Bing.
Right?
There you go.
And then maybe the next year that trip gets bigger. So it's just there. So you got to add that in. So if you need $50,000 to pay your bills and you want $20,000, which is pretty high, by the way, and then you want $20,000 for your trips, then we want to have another 10 grand somewhere. So we want income, a net income of $80,000. So therefore, we really want a gross income somewhere closer to $90,000. And then see if that's sustainable based on what you've saved and all your Social Security checks coming in for the rest of your life. And can we still leave money at the end of the day? And can we afford to self-pay our long-term care based on our plan? So this is why wedding planners get paid the big bucks, because they say, take the fork out, because that's costing me too much. Put the flower. Nope, we don't want 3 flowers. We want 2 flowers, because you have to plan for that, because it can get very costly. And just because you can envision retirement doesn't mean you can plan for retirement. That's why I have a job being a retirement planner for you.
And that is why we say this phrase every single show: let's do the math on your retirement. Let's sit down and actually put all of this down on paper, and specifically for you, customizing your plan specifically for you, not your parents' plan, not your brother, not your coworker and how they retired. It's how you're going to retire. And that's going to take a sit down, a couple of them probably, to sit down and figure out your retirement journey. Give Charisse a call and let's start that process. You know, even if it's 2-3 years away, let's sit down and give you a real good look at what you've done so far. Maybe there's some gaps that need to be filled between now and when you retire. Here's the number. Here is the website. It's 833-368-3680. Again, 833-368-3680, or online, ZinniaWealth.com, ZINNIA Wealth.com. There's a gold box there. It says complimentary retirement consultation. Click on that. You'll fill in a little information there, and our team will reach out to you, and we'll get going on it. Charisse, that is all the time that we have on this segment. I'm going to give you the last word on this one.
Thank you all for tuning in. We appreciate your time and your listenership. And as usual, live by design and not by default. And we'll see you here next week.
This has been Retirement Coffee Talk. To find out more about how the strategies we've discussed on this program can build the retirement you've been wanting, call Zinnia Wealth at 352-368-3680 or visit us online at ZinniaWealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Sharice Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and or categories usually do not deduct transaction and or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.